Let's cover the different agreement components because there's a lot of different sections that you need to be aware of. Usually, everybody focuses on the covenants, but there are other sections such as the conditions precedent or the definitions that it's important to be aware of. Let's take a quick look. Direct lending is governed by loan agreements, which are usually lengthy documents that don't usually have boilerplate templates. They're very bespoke and whose terms must be manually reviewed in virtually all cases. These usually include, first, the definitions used in the agreement, defining the different terms used, such as, for example, what is default or what is EBITDA. These can have different definitions. Then, the capital commitment itself, the principal and the interest rate, the repayment modality, possible call or put provisions, prepayment options and fees, and so on. This is related to the money commitment itself. Then, the conditions precedent. These are things necessary before the loan occurs. Borrower financial status prior to the loan, as well as possible verifications and proof of past payments or creditworthiness, and so on. Then, representations and warranties by the borrower. In short, the borrower stating that all information is true, that they have the power to incur this loan, and so on. This is crucial because the investor needs to be exculpated in case something happens. The business owner is saying, hey, I provided this assurance. So the lender can say, it wasn't my fault in case something happens. Then covenants, which can be thought of as demands on the borrower. These can be affirmative, negative, and financial, as we also cover in this module. Then, describing events of default and remedies for these, both what specific conditions trigger default and what rights the lender has in these cases, such as taking collateral or increasing interest rates or others. Then, if they exist, mentioning the arrangers and or managers of a syndicated loan, as well as their responsibilities and fees. The definitions used in loan agreements are also very important because they can twist returns for the lender and the fees charged. For example, the definition of EBITDA can include what are called add-backs, which are increases for the future that are expected. For example, increases in expected sales, and these make a borrower seem a lot more creditworthy. So here's the thing, it's one thing to say that you have 25 million EBITDA in the present and that you estimate to have the same EBITDA 5 years from now. It's another thing to say that you currently have 25 and you expect it to grow to 75 within 2 years. These are two very different pictures of creditworthiness. Or the definition of default being missing 1 monthly payment or missing 3 monthly payments in a row. All of these different definitions can affect how strong the covenants are or the demands for the borrower at the end of the day. So these changes in definitions can make both the financial situation of the borrower and specific covenants of the agreement more flexible. And to a degree, it makes them less useful. There's no point in the demands being strict about EBITDA, for example, if what you're using to measure EBITDA is not realistic or is flexible to begin with. It's important to note that, unlike in private equity or VC, where there are usually templates for PPMs, private placement memorandums, or term sheets, or even the limited partnership agreement or LPA with allocators, in private debt, agreements are usually bespoke and unique, and complexity can grow quickly with multiple ones. For example, having financing with 3 tranches as a borrower means that you need to have different covenants, fees, terms, definitions, sets of proof, and documentation that can be different for all 3, and naturally, all of them negotiated at the same time, and all of them to keep track of simultaneously for the remainder of the loan term. Again, which is one of the main reasons why unitranche is so popular, because it replaces all of this complexity with one single agreement. What are some examples? The first are warranties. Representation and warranties are the part of the agreement where the borrower warrants the status of their business in multiple ways. They are used to exculpate the lender. What I mean is, in case something goes wrong, the lender can say, hey, I have a warranty from the borrower in which it's stated that everything was legal, so whatever is happening is not my fault. And this is precisely why they're demanded. Then, put on call provisions. A call provision allows the borrower to repay the loan early, to buy back the issued instrument if it's a bond, while a put provision allows the same on the lender's side. In other words, as a borrower, you can buy back the loan, repaying it immediately, and with a put provision, as the lender, you can demand repayment of the loan immediately. Both of these are usually very inconvenient for the other side. The final example are default definitions. Defaulting doesn't need to have a clear definition, which can be dangerous. It may mean lack of payment on time for 1 month, or 1 year, or multiple months, or multiple years, the total amount of payment, or a certain amount of that payment, and many other variations. What are our key takeaways here? The first is that loan agreements are usually lengthy and complex documents that cover in detail the loan commitment, the precedent conditions, the covenants, the definitions, and more. They detail everything about the loan. Then, the definitions definitely impact the agreement. The change in definitions in terms of EBITDA or cushions for numbers in covenants can make the numbers more flexible, which is bad for the lender because the agreement itself becomes less demanding. And finally, both the commitment terms and the covenants will usually be bespoke and based on the specific financing situation negotiated. There is no deal template with specific covenants or specific terms. It's highly dependent on the super specific characteristics of the business, including its cash flow, its asset value, the expected working capital changes, its leverage, capital structure, and much more. So as you see, there are several sections in any credit agreement, but it's important to be aware of the consequences of changes in these. For example, just a change in some definitions can radically alter the quality of covenants, and that's just one example.